Niagara's real estate market is poised to finish the year with a modest increase in prices, with experts predicting the region's abundant resale inventory, as well as its relative affordability, will make it the jewel in the crown in southern Ontario. In its recently released Fall Housing Market Outlook, RE/MAX said Niagara is expected to finish the year with a 2% bump in its price point and a 3% rise in total sales, with a climate said to be a mix between a balanced and buyer's market. Conrad Zerini, owner of RE/MAX Escarpment Realty, said in a typical year, about 40% of sales occur in spring, with another 20% coming in summer months. The fall usually accounts for about 25% of sales. This year, however, could be slightly different. We saw 25% in the first and second quarters. We had a spotty but moderate summer, so you probably did see that 20%. I think we're probably going to see 30 to 32% of all the sales happening this fall, said Zerini, while warning there are wild cards at play. Niagara is going to be the jewel in the crown in southern Ontario. I think there's so much value and there's so much upside to what we have to offer. The blue chip for real estate going forward in Ontario, without a doubt. Since peak sales in March 2022, Niagara has performed very, very nicely, holding its price and sales better than other regions, said Zerini, who also writes forecasts for Hamilton and Halton. He said the availability of homes in the $550,000 to $725,000 range bodes well for the community. Niagara has stock within that sweet spot. When you balance household incomes, down payments, and interest rates, all roads lead to Niagara. In putting together Niagara's numbers, Zerini looks at appointment times, with Friday usually the busiest day. But lately, there are more showings on Mondays, a strong indication the market is healthy and people are dipping in their toes and they're not waiting for the weekend. Zerini said $650,000 to $700,000 properties were in the number one price point over the past few weeks, followed by a tie between those priced between $1 and $2 million and those between $550,000 and $600,000. It's a tale of two cities, but a tale of two products. What you're seeing is the value-conscious consumer looking for greater value, the move-up buyer looking for greater value, then you've got that first-time buyer, he said. RE/MAX said between January 1st and July 31st, the average price in Niagara decreased 1.3% year over year to $697,775, compared with $706,748 the prior year. Sales increased slightly by 0.1% in the same period to $5,699 in 2024 from $5,693 in 2023. Listings increased 11.9% to 13,446 through the first 6 months of 2024. Up from 12,017 in 2023. The Bank of Canada's recent rate cut, its third this year to 4.25%, brings a renewed buyer confidence to the Canadian housing market, the report said. Zerini said the rate cuts are like catching a sword in the air, with some consumers remaining on the sidelines expecting rates to keep dropping. The problem is there hasn't been new construction, so that's added to the inventory mix. We're still only dealing with resale. Believe it or not, there's a lot of inventory, but the stuff that sells, it sells relatively quickly when the consumer sees value, he said. In the end, Zerini said, prices don't decrease with interest rates. Prices decrease when unemployment rises. That's the key differential, and I don't think people get that understanding enough. Prices have held, they've been holding all the way through this higher interest phenomena, he said, adding in the months after rates rose, home prices dropped because everybody was so shocked. When rates stabilized at the overnight rate of 5%, prices moved marginally. When you're talking average price, 1 to 2% just means that more lowest price product is selling, and that's the misnomer about average price. Niagara Association of Realtors also released its fall outlook and is likewise optimistic about an active local real estate market. We expect to see increased market activity, particularly among first-time homebuyers, as affordability improves, Association President Nathan Morissette said in a release. While there is good inventory of listings on the market, that can change quickly, he said. For months, Niagara has suffered from a lack of housing supply. That's why we need our local elected leaders to continue to make it easier to build the kind of homes families can afford. Zerini wants to see the federal government work with municipalities, particularly on development charges, which builders are passing on to consumers. And, he said, a more comprehensive system that looks at development, growth, and employment must be established. Let's talk about the best mortgage rates in Ontario for September 2024. The housing market is starting to cool, and you might be wondering if now's a good time to start researching mortgage rates in Ontario. The ever-evolving landscape of the housing market requires a clear understanding and informed decision-making to make the most of your money. Forbes Advisor Canada presents the best mortgage rates in Ontario for September 2024, aiming to equip you with essential insights and insider strategies to empower your mortgage decisions amidst a dynamic and challenging housing market. So, what are our picks for the best mortgage rates in Ontario? Here are some of the top contenders: Nesto Incorporated, Dominion Lending Centers, The Mortgage Center, Duca, B2B Bank, Laurentian Bank of Canada, and St. Stanislaus St. Casimir's Polish Parishes Credit Union Limited. Let's break down the lowest current mortgage rates in Ontario. As of September 13, 2024, the rates are as follows. For a 3-year fixed mortgage, Nesto Incorporated offers 4.69%. For a 3-year variable mortgage, Nesto Incorporated, Dominion Lending Centers, and the Mortgage Center all offer 5.55%. For a 5-year fixed mortgage, Nesto Incorporated offers 4.19%. For a 5-year variable mortgage, Nesto Incorporated offers 5.15%. Finally, for a 10-year fixed mortgage, Dominion Lending Centers and the Mortgage Center both offer 5.80%. These rates are some of the best Forbes Advisor has seen in this interest rate environment in any province. Plus, Nesto Incorporated is available in 10 provinces. You can apply online and speak to an advisor anytime. Mortgage portability is offered, and Nesto has prepayment privileges of 20% each year. Dominion Lending Centers also stands out with some of the most competitive mortgage rates across all their products, significantly below standard bank rates. This makes them a great option for beating bank rates. The Mortgage Center is another reputable brand with access to hundreds of respected lenders and institutions. Their rates are highly competitive and well below the current prime rate. This makes them a solid choice for lender access. Duca offers a very competitive 3-year fixed rate, though its rates are all insured and high ratio. It leverages its community focus to save residents of Ontario money through great rates and swift approvals. B2B Bank focuses on banking solutions targeted at business professionals through their work with financial advisors. Laurentian Bank offers the same mortgage rates directly to clients. Both banks offer very competitive mortgage rates compared to the big banks and provide a lot of flexibility and options when it comes to mortgage terms. St. Stanislaus St. Casimir's Polish Parishes Credit Union Limited shines with exceptional rates, notably a compelling 3-year fixed-rate mortgage. They excel at serving Ontario's Polish community by blending culturally attuned guidance, personalized service, and competitive prices. To summarize, the best mortgage rates in Ontario for September 2024 are: for a 3-year variable, 5.55% from Nesto Incorporated, Dominion Lending Centers, and the Mortgage Center. For a 3-year fixed, 4.69% from Nesto Incorporated. For a 5-year variable, 5.15% from Nesto Incorporated. For a 5-year fixed, 4.19% from Nesto Incorporated. And for a 10-year fixed, 5.80% from Dominion Lending Centers and the Mortgage Center. The current average mortgage rates in Ontario are approximately 3-year variable at 6.04%, 3-year fixed at 5.69%, 5-year variable at 6.18%, 5-year fixed at 4.95%, and 10-year fixed at 6.46%. These rates are accurate as of September 13, 2024. Fixed-rate mortgage rates are priced off of Government of Canada 5-year bond yields that fluctuate daily. 5-year fixed mortgage rates are typically 1.5% above the 5-year yield, though this spread can vary between 1% and 2%. This means if bond yields go up, fixed-rate mortgage rates also go up. Periods of high inflation cause bond yields to rise. Conversely, when inflationary pressures cool, bond yields also come down. Variable rate mortgages are affected by the Bank of Canada's monetary policy, mainly interest rate hikes and cuts that occur 8 times a year. The prime rate, or the rate the banks use to set the interest rates on their variable rate products, is currently 6.45%, though some banks may post a different rate. For example, TD Bank's prime mortgage rate is currently 6.60%. Variable rates will be quoted as plus or minus compared to the prime rate. On June 5, 2024, the Bank of Canada cut its key interest rate by 25 basis points to 4.75%, its first rate cut in over 4 years. Then on July 24, 2024, the central bank cut rates by another 25 basis points to 4.5%, and again on September 4, 2024, to 4.25%. The Bank of Canada is widely expected to implement more rate cuts this year and into 2025. The Ontario housing market continues to experience a notable slowdown, according to August figures from the Ontario Real Estate Association. Home sales are 23.8% below the 5-year average and 26.6% below the 10-year average. On a year-over-year basis, home sales are down 2.1%. The year-to-date average price was $867,787, while the average price of resale homes sold in August 2024 was $817,915, down 1.3% from a year ago. There was a slight increase of new listings, up 0.7% since August 2023, while active residential listings numbered 58,635 units, up 30.9% year-over-year. In its most recent rate announcement on September 4, 2024, the Bank of Canada cut its key interest rate by another 25 basis points to 4.25%, its third consecutive rate cut in over 4 years. The Bank of Canada was widely expected to continue rate cuts with this announcement. Bank of Canada. Governor Tiff Macklem said the decision reflects two main considerations. First, headline and core inflation have continued to ease as expected. Second, as inflation gets closer to target, the bank wants to see economic growth pick up to absorb the slack in the economy so inflation returns sustainably to the 2% target. While inflation remains above the bank's 2% target, CPI inflation has eased from 8.1% in June 2022 to 2.5% in July 2024. Inflation continues to reflect the push and pull of opposing forces. Overall weakness in the economy continues to pull inflation down, but price pressures in shelter and some other services are holding inflation up. In its most recent monetary policy report, issued in July 2024, the Bank of Canada projected that inflation would ease to about 2.5% in the second half of 2024, then continue its gradual decline before returning sustainably to 2% in the second half of 2025. Risks remain to this outlook, namely persistent high shelter inflation and price pressures from other services that could be stronger than expected. However, Macklem kept the door open for future rate cuts on concerns that inflation could fall too much. The next rate announcement is on October 23, 2024. With federal funding and federal leadership, we're changing how cities let housing get built in their municipalities. With a greater focus on more housing density, student housing, homes near transit, and affordable housing, we're going to get more homes built for Canadians at prices they can afford. Today, the Government of Canada is highlighting key results that have come from the first Housing Accelerator Fund since the start of the program. Today also marks the closure of the application portal for the second round of the Housing Accelerator Fund. The Housing Accelerator Fund was created to incentivize local governments to implement structural and lasting reforms that will increase the supply of housing. Communities like Fredericton, London, Kitchener, Brandon, and Saanich have demonstrated concrete actions, and their respective Housing Accelerator Fund action plans are progressing well and are on track with milestone achievements. London was the first Housing Accelerator Fund city to approve a bylaw to permit 4 units as of right. It has also recently advanced ambitious height permissions of up to 45 stories around its new bus rapid transit stations in the downtown core. London's downtown will see additional homes created in vacant office buildings through a recently announced office conversion grant program funded by the Housing Accelerator Fund. Fredericton committed to allow 4 units as of right citywide and to increase density in proximity to post-secondary institutions. As part of its Housing Accelerator Fund action plan, Fredericton is also committed to partnering with local First Nations housing providers for off-reserve affordable home ownership. making city-owned land available to enable mixed-use developments, and partnering with manufactured home builders to promote alternate forms of housing. Kitchener has also become one of the first Housing Accelerator Fund communities to fulfill its commitment to approve inclusionary zoning. In April, the city donated land to fulfill part of its Housing Accelerator Fund commitment to help support the creation of 10,000 half-price homes through the Build Now Waterloo Region initiative. Brandon reflected the spirit of the Housing Accelerator Fund with ambitious efforts to exceed the agreement in terms of parking and density. They have introduced a program to incentivize housing in the downtown, using $1.5 million in Housing Accelerator Fund funding for developer tax credits, development charge offsets, and capital grants. Saanich focused on pre-zoning of university-owned sites for multi-unit developments, providing much-needed accommodation within walking distance to the University of Victoria. They have also developed new parking standards, digitized the application process, and revised the review process aimed at enhancing the speed and number of new permits. With these measures in place, and those of the 178 agreements across Canada, it is expected that the Housing Accelerator Fund will help cut red tape and fast-track at least 100,000 permitted new homes over the first 3 years, which cities and regions estimate will lead to the creation of over 750,000 permitted homes for people in towns, cities, and Indigenous communities across Canada over the next decade. The Government of Canada is making life more affordable for Canadians, and housing is key to our work. We will work with provincial, territorial, and municipal governments, as well as Indigenous partners, to keep building more homes for Canadians faster. The Housing Accelerator Fund is currently helping 177 communities across Canada increase their ambition on housing by reaching their goal of increasing housing supply in their municipality. By working with towns, cities, mayors, and all levels of government, we're helping to get more homes built for Canadians at prices they can afford. Local governments were encouraged to think big and be bold in their approaches, and they are now implementing transformational approaches that create a pathway to solving the housing crisis in their community. With the support of the Housing Accelerator Fund, municipalities are ending exclusionary zoning and removing barriers to development, making land available for housing, and improving development approval processes to make it faster and easier to have housing proposals move forward. Rural municipalities are also implementing changes that meet the needs of their communities, with a greater focus on updating local infrastructure and modifying zoning for more gentle density options. The first round of the Housing Accelerator Fund program received 544 applications, of which 178 resulted in signed agreements. Launched in March 2023, the Housing Accelerator Fund is a $4 billion initiative from the Government of Canada that will run until 2026 to 2027. The federal government announced in Budget 2024 an additional $400 million to the Housing Accelerator Fund to incentivize an additional 12,000 new homes in the next 3 years. The Housing Accelerator Fund is part of Canada's National Housing Strategy, a $115+ billion plan to give more Canadians a place to call home. Progress on programs and initiatives are updated quarterly at www.placetocallhome.ca. The federal government is taking a whole-of-government approach to build more homes by bringing down the costs of home building, helping cities make it easier to build homes faster, changing how homes are built, and growing the workforce to get the job done. Make it easier to rent or own a home by ensuring every renter or owner has a home that meets their needs and the stability to retain it. Help those who cannot afford a home by creating more affordable housing and eliminating chronic homelessness.